Hi everyone. We are now going to look at two practice problems from your book. The first one we're going to look at is problem 823A, which is really demonstrating our flexible budgets and spending variances, the first part of the chapter. So on page 393, you have been hired by FAB Corporation, the manufacturer of a revolutionary new garage door opening device. The president has asked you to review the company's costing system and do what you can to help us get better control of our manufacturing overhead costs. You find that the company has never used a flexible budget, and you suggest that preparing such a budget would be an excellent first step in overhead planning and control. After much effort and analysis, you determined the following cost formulas and gathered the following actual cost data for March. During March, the company worked 26,000 machine hours and produced 15,000 units. The company had originally planned to work 30,000 machine hours during March. So, in order to first calculate our flexible budget, we will be using the actual machine hours. Here, 26,000 hours. Our utilities would then be budgeted in our flexible budget by taking 20,600 plus 10 cents times 26,000. I'm sorry, yes, 26,000. Add those two amounts together, 23,200. So remember, this is our budget side. In the maintenance, the budget is 40,000 plus $1.60 times the actual quantity here of 26,000, giving us $81,600. Supplies are 30 cents per machine hour of 26,000, or $7,800. Indirect labor is $130,000 plus 70 cents per actual machine hour. Remember, this is creating our our flexible budget. Our planning budget would have used the amount they had originally planned for, which was 30,000. The depreciation is 70,000 in our budget, so there's our cost formulas are used with actual production or machine hours in this case to get our flexible budget. So the total cost would equal under our flexible budget $330,800. Now let's compare the actual results to those we just computed using the flexible budget. It's flexible because we recompute our original planning budget using actual production results rather than the amount expected. So, with regards to our utilities, we had 24,200 actual versus 23,200 flexible budget. So we spent $1,000 more than budgeted. That's unfavorable. For maintenance, we spent $3,500 less than flexible budget, so that is favorable. Supplies are $8,400 were spent compared to the flexible budget amount, so the budget based on actual production of $7,800, unfavorable budget difference or variance of $600. Indirect labor, we spend $1,400 more than our flexible budget amount, so it's unfavorable difference. And depreciation was $1,500 more than budgeted. So overall, when you add and subtract those items, individually you could see which one was favorable, which are unfavorable, and overall. So an unfavorable spending variance means that the actual cost was greater than what the cost should have been for the actual level of activity. So that what the cost should have been is the flexible budget. A favorable spending variance means that the actual cost was less than what the cost should have been, or the flexible budget amount. While this makes intuitive sense, sometimes a favorable variance may not be good. For example, the rather larger favorable variance for maintenance might have resulted from performing less maintenance. Since these variances are fairly large, they should all probably be investigated. Remember, that's what we're doing here, finding items that need to be investigated because of the way the actual spending compares to what the budgeted spending would be. So that is how you would prepare your flexible budget and then a report showing the spending variances. We're now going to move on to actually go backwards. And I picked this problem because of the person's name. No, I'm kidding. Problem 8-18A. Now we're going to be focusing on the rest of the chapter, where we're computing price variances and quantity variances. Miller Toy Company manufactures a plastic swimming pool at its Westwood plant. The plant has been experiencing problems as shown by its June contribution format income statement below. So as you can see, there's a budget amount and an actual amount, and how the contribution margin is much lower on the actual than the budget, and net operating income overall is much less on the actual than on the budget. So we need to investigate why. Janet Dunn, who has just been appointed general manager of the Westwood plant, has been given instructions to get things under control. Upon reviewing the plant's income statement, Ms. Dunn has concluded that the major problem lies in the variable cost of goods sold. She's been provided with the following standard cost per swimming pool. So direct materials, standard quantity is 3 pounds per pool. $2 per pound is the standard price or rate. So overall standard cost, $6 per pool. Direct labor, 0.8 hours is the standard quantity of hours. $6 per hour is the standard price, resulting in $4.80 per pool. Finally, variable manufacturing overhead, which is the one we want to use because that's the only one that could change, 40 cents per hour, or I'm sorry, 0.4 hours is the amount of time to calculate the variable manufacturing overhead. $3 per hour is your standard rate, giving you $1.20. During June, the plant produced 15,000 pools, and it incurred the following costs. So we have purchased 60,000 pounds of material at a cost of $1.95 per pound, used 49,200 pounds of material in production, worked 11,800 direct labor hours at a cost of $7 per hour, incurred variable manufacturing overhead cost totaling $18,290 for the month. A total of 5,900 machine hours was recorded. It is the company's policy to close all variances to cost of goods sold on a monthly basis. So the first thing they want us to do is compute the following variances for June: materials, price, and quantity, labor rate and efficiency variances, and variable overhead rate and efficiency variances. So that handles the second part of our chapter. So let's take a look at that. I gotta scroll down, not back up. All right, so here's our first one, where we're going to now calculate the variances for materials price and quantity for the month of June. Now what we want to do is first take our actual quantity of input at actual price. So 60,000 pounds was what they actually purchased times $1.95 per pound. Actual quantity of input at standard price is our next computation. So the difference between our first computation and our second, what changed? The price per pound. In the first computation, we used the actual price. In the second, we used the standard price we expected. So the difference in pricing caused a $3,000 favorable price variance. And you can see that we paid less money than we expected. So the difference in price in these two calculations would be favorable. The next thing we do is do a budget. So that middle column you could look at as our flexible budget computation. And the last column is our planning budget computation. Standard quantity, what did we expect? 45,000, hold on, let me find it. 45,000 pounds. Sorry, I know it's here. And how do we get that? 15,000 pools were produced, 3 pounds. So the standard quantity should be 45,000 pounds times the standard price. Now, the price difference here was the flexible budget was 120,000. The planning budget is 90,000. A $30,000 difference there. Okay, between the 120 and the 90. Now, since we didn't use 60,000 pounds, that's what we bought, we want to compute the amount of used materials to determine the actual variance, quantity variance. What this is saying is we actually used 49,200 pounds. We bought 60, but we actually used 49,200. What's the standard rate or standard price here? $2 per pound. So 98,400 is the amount you're going to compare to the 90,000. Because if we didn't, it would look like we used 60,000 pounds. We didn't. We only used 49,200. So the price difference between the flexible budget and the planning budget of 8,400 is an unfavorable variance. We should have used less pounds. We should have used 45,000 pounds. We used 49,200. So because we used more, it caused an $8,400 unfavorable quantity variance. So we could see here the difference between actual and budget is a combination of price differences and quantity usage differences. What we're doing here is breaking those two differences out and determining, was it a favorable difference for the price? Yes, we actually paid less. Was it a favorable difference for the quantity? In this case, no, we used more than we should have. And it's defining it in terms of money. Now, in B, labor rate and efficiency variances. Now we're going to look at labor. Again, determine actual cost of labor, actual hours at actual rates. 82,600 was the actual amount you paid for labor. What's the flexible budget amount? Actual hours times standard rate. 11,800 hours times $6 per hour. 70,800. The difference there of 11,800 is unfavorable. It's a rate variance. Why? Because we paid more than we had budgeted for. We paid $7 per hour instead of $6. That caused an $1,100, $800 overall unfavorable variance in labor. We now compare our flexible budget to our planning budget amount, which was standard hours times standard rate, 72,000. In this case, we are actually in a favorable efficiency variance. We used less labor hours than we budgeted. We budgeted 12,000 to make those pools. We only used 11,800. So the difference in hours times that $6 per hour gives us a dollar value for the efficiency variance. favorable of $1,200. So overall, we spent $10,600 more than we had budgeted in our planning budget. This rate variance and efficiency variance tells us where the variances occurred. The rate variance tells us if we used more hours or less hours than we paid more per hour or less per hour, and the dollar amount that caused our difference. The efficiency variance tells us if we used more or less hours and the dollar value attached to those hours. The next computation was on our variable overhead rate. Again, take your actual hours times your actual rate, 18,290. And I'm going through it, and that was given. That's in D. 18,290 is how much the manufacturing overhead was for the month. What's the flexible budget say it should be? Well, take your actual hours used, 5,900 machine hours, times $3 per hour times $3 per hour. Okay, so take your actual hours, 5,900, times your standard rate of $3 per hour, 17,700. So the difference in what you actually paid in variable overhead and what your flexible budget says you should have paid is a spending or rate variance. In this case, you paid more than you should have. You should have paid only $17,700 for the actual hours you used it. So there's a $590 unfavorable variance. Now let's see the efficiency side. The actual hours used were 5,900. The budgeted hours are 6,000. Well, you needed to compute that. 15,000 pools were produced. Variable manufacturing overhead is measured in 0.4 hours. So 15,000 pools times 0.4 hours gives us a total of 6,000 hours. Multiply the 6,000 budgeted hours times the standard rate, that's your budget rate of $3 per hour, $18,000. So you essentially used less hours than you budgeted to make those pools. Translating that to a dollar amount, take the difference between your flexible budget amount of $17,700 and your planning budget amount of $18,000. $300 favorable variance. Overall, your spending variance is unfavorable, 290. You spent 290 more than you had budgeted originally. The rate variances and the efficiency variances define where your inefficiency or efficiencies are at. So that is how we calculate those various the different types of variances. How's that? Now we need to summarize the variances by showing the net overall favorable or unfavorable variance for the month. So here we'll take that favorable material price variance, we'll subtract the unfavorable quantity variance, subtract the unfavorable labor rate variance, add the favorable labor efficiency variance, subtract the unfavorable variable overhead rate variance, and then add the favorable variable overhead efficiency variance. You should come up with a negative 16,290, unfavorable. So this net unfavorable variance for the month caused the plant's variable cost of goods sold to increase from the budgeted amount of $180,000 to $196,290. So we're explaining why that amount changed on page 389. That's what we just did the computation for. And that's what they wanted us to do. So this 16,290 net unfavorable variance also accounts for the difference between the budgeted net income and actual net income. And there's the difference. Okay, so the budgeted net income on page 389, 36,000. The actual, 19,710. And that's all because of these favorable and unfavorable variances between materials, labor, and overhead. We're defining them now, so now we know where we need to make corrections. What caused the issue? In part 3, pick out the two most significant variances. Explain to Ms. Dunn possible causes of these variances. Well, if you look back up here, one that sticks right out is the labor rate variance. Labor rate variance, there could be outdated standards. Maybe we need to update those standards. Maybe a change in pay scale occurred, or maybe we were paying overtime pay during that time period. That would change that. Material quantity variance, another huge unfavorable variance. What could cause that? Again, outdated standards. Maybe our budget amounts aren't correct. Unskilled workers that are using more materials than they should. Because materials quantity variance means you're using more materials than you should if it's unfavorable. Poorly adjusted machines. Maybe the machines are the ones that are causing the issue, causing us to use more materials than necessary. Carelessness of the workers, poorly trained workers, or the quality of the materials are inferior. So the variances give us an insight into problem areas, and then we take the next step and determine the why. What could have caused these unfavorable variances? And that's why we have flexible budgets, standard costs, and variance analysis. So please make sure you listen to the videos. I wasn't going to recreate the wheel. There's some great videos out on YouTube already about this subject, so I posted those out there for you to listen to. Go through the exercises, and if you have any kind of questions, please post them to the discussion board.